This is a production of O'Brien Communications.
Hello, friends. I'm Tim O'Brien. A few years back, I worked on the annual report for this big Fortune 500 corporation, but it wasn't just any annual report. It was the company's corporate social responsibility, or CSR report. That was where the company tried to measure its impact on the environment mostly, but other things too. Over the years, newer movements have tried to find ways to measure companies in ways other than financial returns. But from what I've seen firsthand, they've struggled to do so. The boldest and biggest effort to do this was the emergence of ESG investing. ESG stands for Environmental, Social, and Governance Investing. And just like other attempts before it, ESG has faced its own struggles. With that in mind, I saw a really great article from our guest today, and I thought it would be a good idea to have him come on our podcast to explain it. Before we get started, though, I just want to do a couple housekeeping items. If you're watching on YouTube or Rumble, make sure to hit that subscribe button. And if you're listening, wherever you're listening, give us a good rating and review. Today, we're joined by Sanjai Bhagat. He's Provost Professor of Finance at the University of Colorado. He's also the author of a book called Financial Crisis, Corporate Governance, and Bank Capital. But what caught my attention was an article he wrote for Harvard Business Review in March of 2022. The title of that article is called An Inconvenient Truth About ESG Investing. Welcome to the podcast, Sanjai.
Thank you. Thank you for having me.
I appreciate your coming on. Well, I think it's not enough to just say what those three letters stand for when we tell the listeners and the viewers that. So if you could, just from right out of the gate at the top, tell us, what does ESG mean?
So ESG, as you noted in your introduction, the E stands for environment, the S stands for social justice or social, and G stands for governance. The environment would include things like carbon footprint, energy consumption, fresh water consumption, land use, and so on. And that includes waste hazardous material management. The social or the social justice part includes consumer rights, data protection, employee hiring, promotion practices, DEI, policies of the company. Governance would include board composition, board independence, board diversity, board compensation, executive compensation, shareholder voting rights. So that sort of gives you the broader landmark. And I've just listed a few of the items that come under ESG. ESG is also many researchers use it synonymously with CSR, that stands for corporate social responsibility. Those are, almost those terms they use interchangeably in the research and also some of the media. And another phrase or another word that is used interchangeably is the word sustainability or sustainable business practices. So all of these terms, they relate to the same underlying concept on ESG.
Now, those are what the terms mean. When we think about them in practice and what it's supposed to be, because I know we're going to talk about the reality versus the theory, that's actually our focus today. But in theory, how is ESG supposed to work? If I'm an investor and a company gets a good score on the ESG score, as you said, CSR score or sustainability score, if I get a good score on ESG, what does that actually mean?
To be honest, nothing. I mean, that's my objective answer. Now, what some of the researchers that have worked on this ESG, like there is a literature on ESG ratings itself, and that has highlighted the controversies and the inconsistencies in the various ESG ratings that are provided by for-profit commercial vendors and even some non-profit organizations are providing ESG ratings on literally tens of thousands of companies worldwide. And when researchers have very carefully looked at the correlation amongst these ratings and try to relate that with some underlying variables, like, if a company was rated very highly on the environment, you think that, sort of prima facie they would have a good environmental record. Not so. To just give you an example, the recently one, I will not mention any names of any rating agencies. One very well-known rating agency rated both Volkswagen and Tesla. Tesla, as you know, is the electric car company, and while there's a lot of controversy about whether or not electric cars cut down on carbon emissions and are good for the environment, let's just stipulate that electric cars are good for the environment. And so that's Tesla. And then you have Volkswagen that has been recently, it's been 2 or 3 years now. They had to plead guilty to criminal violations of the EPA disclosures, and they have been fined quite severely. And all that's in the press. It's sort of out in the public. And guess which company gets the higher environmental and ESG rating?
Well, I'm going to guess it was Volkswagen.
Yes. So, look, this is just one example by one rating company, but it just sort of highlights the problem with ESG ratings. That and so there's a more fundamental problem with ratings, ESG ratings, or the precursor to ESG rating were these corporate governance indices, on which I did a lot of research, and that's why I was pretty. It was clear to me where the problem would be with the ESG. So when you have ratings, like we went through a short laundry list of items that would go into environment, like carbon footprint, energy consumption, waste hazardous material. Social would include employee hiring practices, DEI, health safety. Governance would have board composition, board compensation. Now, what we are talking about are these are just an incomplete list of items under each of these three. So first, you have to decide what are the relevant aspects of each E, S, and G. And the list can be very long. Okay, so first is the issue of what items should go into the E, S, and G. Then you have to decide how much weight should each of these items get in E and S and G. And then you have to decide, how much weight you want to give to E, S, and G separately. And the only thing that is known is that the weights that are given to E, S, and G have to sum to 1.0 or 100%. Beyond that guidance, there really is no. You can give whatever weights you want to E, S, and G, and the items under any of those three. And so that's with just the weighting aspect. Then there's the other issue of, how do you measure any of these issues? Like, how do you, for example, measure DEI practice of a company? Is it the number of lawsuits that have been filed against them? Is it the proportion of their C-suite or workforce that has some demographic characteristic? How do you weight those characteristics? None of these things are necessarily universally agreed upon. And so, a priori, it was pretty clear to me that these ESG ratings were not going to be very helpful to either researchers or to corporate boards or CEOs or regulators. And then, of course, there were these several papers came out. I think one or two of them may have been recently published that just highlighted the inconsistencies and the measurement problems and the weighting problems of ESG ratings. And so that itself is an issue at this point. Though broadly, at least, we understand that ESG is sort of ESG policies of a company are focused on environmental policies, social justice policies, and then governance. But trying to measure a company's ESG, that's going to be very challenging.
You've been rather vocal on this, and I'm in the public relations field, and the whole language and the whole philosophy of ESG is almost sacred in some circles. And as I said in the upfront, I actually handled the CSR report for a big company for 3 years. So it wasn't just a one-off for me. I got very familiar with the process, and really I got into the weeds with the company on what they were exactly measuring, and like you said, assigning values to things. So I can only imagine, especially after that Harvard Business Review article, you probably heard some backlash from some people. What was the reaction to that Harvard Business Review article and maybe some of your other things that you've said about ESG?
So, again, the nice thing about the Harvard Business Review article was that I could hyperlink the underlying papers that I was basing my arguments on and the underlying data I was referring to. So people could, at least the more serious audience or the researchers or readers that were looking at it very critically, but somewhat objectively, went and looked at the underlying sources, and most of them found that, almost everything I was saying there was based on the underlying research, and most of the research was not mine. It was out there in the academic research media, and some of the articles were in the popular media also. So so the serious readers, sort of, while they might not have liked the result or liked the conclusion or the evidence that I was highlighting, they understood where it was coming from and why I was saying what I was saying. There were, unfortunately, one or two, I guess, responses I got from people that had not taken the time to read the underlying research, which were hyperlinked, and I think made, I'd say, some non-objective remarks.
I could see that. And as I mentioned, I did that annual report for CSR, but I've also been active in investor relations for many years. And I was the investor relations director for a company at one point. So I remember talking to analysts. I would sit across the table from funds like Fidelity and all the big funds. And, they measure, everything's quantified for them. So you really have to understand something about that culture, because they're handing billions of dollars, in some cases now trillions of dollars, and they're sitting across from companies trying to get information so they can quantify their evaluation of this company. And on their word, people will invest, or other funds or other banks will invest. So this is all about return on investment. And it's hard enough to measure money. It's hard enough to remember earnings per share and measures like that are kind of industry standards. And you also have to put yourself at the end of the cycle, which is, let's say that retiree who retired from the railroad company 10 years ago, and his IRA or his 401k, he's living on that now. And he wants to make sure that whoever's managing the funds of his retirement accounts are properly managed so that he can continue to pay his bills and live off of that money. So he wants to know basically, is my money earning a profit, or is it performing well, and what needs to be done just so that I can have the money to live. That's how basic that end user's needs are. Then you throw in ESG, and now all of a sudden you have those same funds like Fidelity or whoever that are saying, yeah, Mr. Retiree who retired 10 years ago, you're not making as much money as you were, but you should feel good about this because, you're getting a good ESG score. And I know I don't want to sound too skeptical or cynical, because I know the intent behind ESG is it's not only well-meaning, but it does acknowledge that companies are much more than just financial returns. They have to be more than that. They have to be conscious of stakeholders and employees and other groups. However, when you're measuring things for the investment community because they want that return, that's where there's this almost lack of a fit. And that is really what your article says. And that is what a lot of your research says and a lot of other things say. So there's been so much negativity in the investment world. We're not even talking political at this point.
Yeah.
But there's been so much negativity about it's apples to oranges. You can't compare ESG to all the various measures that we provide to measure company performance. So now I wanted to bring this person up to you and ask you what you think, because probably the gold standard for the whole issue of ESG is BlackRock. And the big standard bearer for ESG is the CEO of BlackRock. His name is Larry Fink. And in June of 2023 at the Aspen Ideas Festival, he gave a speech. And now they were the ones, if BlackRock didn't get behind ESG, there wasn't really going to be an ESG. They manage trillions of dollars around the world. I mean, governments trust them with their money. So they're so big that they can dictate almost what happens, definitely among the companies that they invest in. He said that ESG has become too politicized. And I'm going to put something on the screen here. He said, I don't use the term, he said the word ESG anymore because it's been entirely weaponized by the far left and far right. So he was alluding to it being sort of a political thing. But I think your research and even other articles about BlackRock say it wasn't just political. He's sort of saying that as a scapegoat, but it was really the investment community looking at BlackRock and a lot of other people. Now, when we say investment community, we're also talking funds. We're talking about retirement accounts from the school teachers of Texas, retirement accounts from all the school teachers and maybe pensioners and government employees in the state of Pennsylvania. I don't know where they stand on it, but that was just a hypothetical example. So my thing is, you have these big funds that are basically looking at BlackRock and they're saying, we don't want you investing our money in ESG leaning funds if they're not performing well financially. And that's what it all comes down to. So that's a long setup basically for the question. Where do you come down on that, on what Larry Fink said about that this was too weaponized? Was it that the term was too weaponized, or is it something more fundamental?
I certainly wouldn't want to comment on why he would say something he would say, but I can certainly talk about what the evidence is with regard to returns on funds that have emphasized sustainability or ESG in their investment practices. So there is this paper in the Journal of Finance, December 2019, that I have hyperlinked in my Harvard Business Review article. So they look at about 20,000 funds. These are hedge funds, mutual funds, pension funds. That Morningstar tracks these funds. Morningstar is the industry's gold standard for providing data on funds of all types. Starting March of 2016, Morningstar started rating all the 20,000 plus funds that it tracks and gave them 5 globes if, in Morningstar's opinion, the fund was acting very responsibly with regard to sustainable business practices, ESG practices. So this was Morningstar's rating. 5 globe if you're doing a very good job, 4 not so good, 3 not so good, etc. And then 1 star meaning you have a lot of work to do with regard to ESG practices. Okay, so these all the funds got rated in March 2016. And then these researchers tracked the performance of the funds that were rated as 5 globe and funds that got rated as 1 globe. And what they found was, now when you're tracking funds over the long periods of months and years, there's always the issue of, how do you adjust for risk and what's your benchmark and so forth. But basically what these researchers found was that the one globe funds, meaning the funds that Morningstar was saying they needed to do a lot more work on ESG, always outperformed in terms of returns the five globe funds that Morningstar said were doing an excellent job of their ESG and sustainability practices. Now, they tried a variety of benchmarks, a variety of risk adjustments under all of the alternative ways they try to adjust for risk and benchmarks. They always found that the one globe funds outperformed the five globe funds, and sometimes they outperformed it by a statistically significant margin. So that's one study. There are other studies that have also looked at performance of funds, in a more recent time period, with measurement techniques are different and so forth. In fact, there are literally more than thousands of studies at this point. Many of them done by finance academics, some done in the economics department, even the some of the demographers in geography departments are now getting into this ESG and stock returns correlation issues. And so, if you wanted to, you could, given that there are 1,000+ studies out there, you could easily find maybe a dozen studies that show a positive correlation between ESG and returns, meaning funds that have a focus on ESG have a higher return. You could find probably a dozen or more studies that show no relation between ESG return, between ESG practices and returns. Or you could find a negative correlation like the one that I highlighted. Fortunately for us, meaning people that pay attention to this ESG and investment fund returns issue, there is a very recent paper coming out of NYU that's been recently published, and it may, not sure if I have a link to that in my HBR paper, but it is certainly linked to the slide that I sent you. So in this paper, the researchers look at more than 1,400 studies, peer-reviewed studies that were published between 2015 and 2020. So fairly recent data. And then they sort of do this meta study, meaning trying to get the underlying, so you're looking at these 1,400 studies, what's the bottom line with regard to ESG focus of a fund and its returns? And they find that the returns, there's a negative correlation. So funds that focus more on ESG seem to underperform funds that have a more traditional or a non-ESG focus. So that's the data. Now, with regard to an issue that you raised earlier, that companies are not just about financial performance, and that point is valid. I think it's a very sensible point. So managers are also aware of it. So, they are sort of, to kind of keep this discussion manageable, let's say that, we have two narratives of what is it that a company or a company's managers board should be doing. So in the first narrative, what we refer to as the shareholder value maximization viewpoint, as Milton Friedman first articulated it more than 50 years back in an op-ed in the New York Times, he said the company should be maximizing long-term shareholder value while adhering to the law of the land. And that's been sort of, labeled as the shareholder value maximization principle. An alternate one that is attributed to the Business Roundtable, and they had this one-page Wall Street Journal ad in August of 2019, and they said that companies should be now thinking more about their customers and employees and communities and the environment and so forth, and shareholders too. But they said that the focus should be on all of these stakeholders. Now, if you think about the shareholder value maximization principle, you have to ask yourself, what rational CEO is not going to care about their employees? That happy employees make happy customers lead to revenues, with revenues. Now you have earnings. If you don't have revenue, you don't have anything. You don't have a business. So they, even if the manager, let's say for the sake of argument, is not concerned about employees or customers, they have to be paying attention to the well-being of employees. Similarly, if they have to compete with other companies in the industry, they have to be concerned of that the product or service they're providing to their customer meets the customer's expectation of the quality at some price. And if not, the customer has other options and they go elsewhere. And the company loses business. And if that keeps going on, the company goes under and the manager is without a job. And they take a big reputational hit too. So managers, boards, at some level understand that, look, to even to create long-term shareholder value, we have to be concerned about our employees and customers, and the same about environment, with reputational effect, communities, and so forth. The strength of the shareholder value maximization viewpoint is that managers have to look at customers, suppliers through the lens or the discipline of shareholder value. Now, why is that important? Let's think about this stakeholder paradigm that was espoused by the Business Roundtable, and it's also been espoused by others like Mr. Fink back in 2021. He was very articulate in talking about stakeholders. And then the Davos, the annual get-together of, I would say, very important people in the world. Every February, they meet in Davos, Switzerland. They also have been talking about this ESG. So over there, you have these stakeholders, employees, customers, suppliers, communities, environment, and then shareholders. And the manager is told that all of these stakeholders are important. Okay? Well, how much weight do you want to give to these shareholders? I mean, who's more important than the other? It's totally silent on that. And this is not a esoteric discussion. Let me give you a real world example. In 2019, GM's managers had to make a decision about two assembly lines, one in Michigan, one in Ohio. These assembly lines at that time were producing gasoline and diesel cars and trucks, and these two assembly lines employed about 3,000 workers. The question came up if they should convert these two assembly lines to producing electric cars and trucks. Let's just assume that electric cars and trucks are better for the environment. So they could, really help the environmental part of their equation by converting these older gasoline and diesel car and truck assembly lines into assembly line for electric cars and trucks. That would be good for the environment. But since these newer assembly lines would require less employees, so instead of 3,000 employees, they only would require 500 employees, meaning 2,500 employees would be laid off. Laying off an employee is very bad for the employee. So on the one hand, GM could be very nice to the employees, continue going the way they're going, or they could say, okay, we're going to go the environmental route, lay off 2,500 workers, refurbish these lines, and make electric cars and trucks. So they have to choose between employees and environment. How do they choose? If you ask stakeholders, people that espouse stakeholder principles, they say, well, both are important. Yeah, both are important, but the managers have to do something. They can pick one or the other. They can't pick both. So there is no guidance from the stakeholder principles what managers should do in cases like this that do come up fairly frequently. If you look at the shareholder viewpoint, at least there's a guidance. There you say, okay, what's the impact on shareholder value of staying the way we are staying, making gasoline, diesel cars and trucks? What's the impact on shareholder value of changing it to electric cars and trucks? Laying off employees, so you have to pay whatever layoff, compensation you have to pay, and then the cost of the new assembly lines and so forth. So by looking at the impact on the company's value, the managers have some guidance which way to go. Those calculations are not going to be easy, but at least there is some intellectual guidance as to where you have to go. And these kinds of calculations are done routinely in corporate finance departments in companies. So it's, while complicated, this is not totally new. I mean, this does get done. Now let's get to the so I kind of gave you one, what I'd say, the problem with the stakeholder paradigm, which I would sort of, so the good, so like you're talking about that movie, The Good, the Bad, the Ugly. I'm trying to take you there. The good part was the shareholder value maximization. The bad part was, I just described the stakeholder viewpoint where managers have no guidance as to how much wage to give. Now, then there's an ugly part of the story that doesn't get talked about, but you may actually have been very familiar with parts of the story. So every quarter, as you know, the CEO and the CFO of companies, they have a public teleconference with analysts that follow their company. Now, these are public meetings. Anybody can listen in if they wanted to. And what goes on in those teleconferences is recorded and then transcribed. And then there are databases you can go to, and you can read that, whatever happened, whatever was said in those meetings. You may have gone to some of those meetings. It sounds like, with your background in investor relations.
I have. Yes.
Yeah. So, okay. So these meetings are transcribed in words, it's there. And now with the high-powered computers we have and access to textual data programming languages, researchers have gone and sort of analyzed, what gets talked about in these meetings. And what they found was that when companies' financial performance was subpar. So what do I mean by that? So let's say that the analysts were forecasting that for some company, their earnings per share would be 50 cents a share. And the manager comes out to the teleconference, says, "Good morning, everybody." And our earnings per share this quarter are 35 cents a share. So they're underperforming.
You missed expectations.
And on the low side. And in those meetings, these researchers found there's a lot of talk about ESG and sustainability and corporate social responsibility. A lot of talk of that at various in various contexts. Okay. Then you go look at companies where the company's performance was more than expected. So market was saying, okay, you will have 50 cents a share. And the CEO comes out and says, this quarter our earnings per share were 70 cents a share. Guess what else was discussed in that meeting? Or what else got talked about?
Well, just based on my experience with that kind of thing, you now have Regulation FD. That's fair disclosure. So it's not like the old days where analysts sort of had this inside track on the company. Right. So like you said, everything is public. Analysts get the same information that railroad retiree I told you about. Right. So what did they describe? They talked about the company's performance, sales revenues, whatever expenses they paid, any kind of liabilities that influenced in a material way that EPS number that you talked about, right. Because that EPS number is where the stock rises and falls, right, on that announcement. Now, I'm guessing you're going to say ESG is the other thing they talked about.
No. If they exceed market expectations, so like they got 70 cents a share, the market was expecting 50 cents a share, total radio silence. No talk of ESG, or very little to no talk of ESG, sustainability, corporate social responsibility. And they looked at literally tens of thousands of teleconferences over a decade, looking at all the US listed companies. So this is not like a one or two company example. So when managers exceed expectations of financial performance, there is no talk of ESG. In fact, this relates back to what many of your viewers might relate to a sports analogy. So if you have a great football player like a running back or a quarterback, or if you have a great basketball player, given this is the basketball time of the year, or a great hockey player, they do their talking on the field or on the ice or on the court. especially if they win. So the great players, they leave on the great athletes, they leave the talking. They let their performance on the field or on the court or on the ice do the talking. And so that's the other dark side of it, is that companies that are not performing up to their financial expectations of the market, they are the ones that talk a lot more about ESG. Let me quote. I mean, so this is not my study. It's linked up on the slide I sent you.
Let me clarify something you just said, because I think just to reinforce what you just said, and I read it too in some of your writings and your other work in the PowerPoint slides you sent me last night, and it all reinforces the same thing, and that is ESG can be a drag on profitability. So when a CEO has to tell the investment community, hey, we didn't do so well this quarter, everybody, he or she may go to that scapegoat, ESG, because they can kind of get a pass, because people can say, oh, well, they did it for a good reason. They missed earnings for a good reason. It's not like they missed earnings because they got sued for some environmental problem. They missed earnings because they were devoting too many resources and too much attention to complying with this ESG standard for them that has nothing to do with financial returns, but they're a better corporate citizen. And that's the dynamic I believe that you're talking about. Is that correct?
So now you're, I think, getting into sort of the specifics of what the discussion was. And on that, I don't have the detail, or at least in that research I'm referring you to, we don't have the detail. But the summary of their research is that when your actual financial performance is below expectations, the managers talk a lot about their focus on the E and the S and the G parts of ESG. That the company is sort of really focused on community efforts, on environmental issues, employee welfare, all those kinds of things they will talk about. Now, like I told you, all companies from just a shareholder value maximization viewpoint have it in their own interest to pay attention to employee benefits, employee well-being, customer expectations, environment, and so forth. So they have their own longer-term self-interest to do that. Additionally, all companies have to abide by EPA requirements and OSHA regulations and Labor Department regulations, and the Justice Department antitrust rules. So, there is a larger context that it's not that these companies that weren't talking about ESG, they weren't talking about it, but they really had to pay attention to those details to have the performance at the level that they're talking about. But they have been able to run a tight ship, generate higher earnings than investors are expecting, which would lead to a higher share price eventually. So that's the way that I would cast it, is that not that, they were doing other things. Well, you didn't meet expectation, and now you're sort of pointing out the managers that beat expectations. They could also have pointed out to their emphasis on various ESG items, and some may have, but by and large, they chose not to. They just talked about their financial performance and what lies ahead in terms of their business strategy and so forth.
I wish we had a lot more time to talk about this, and I'm sure that is why you'd spend a whole semester talking about these things with your students. But there is $1 million question, literally, and that is, why is it when an ESG fund fails? And when we talk about ESG funds, we're talking about, let's suppose you invest in Fidelity. I mentioned them as just an example, but let's say you invest in a Fidelity fund or some other fund that tells you that, hey, you're focused on ESG stocks. These companies have good scores on ESG. That's why we invest in them. Why do those funds, on average, when they do poorly, is there something about the ESG score that causes them to perform below the market standard? What is it that causes them to underperform?
So the part of the answer is in the example that I just gave to you about that research, where when CEOs talk about ESG a lot in the teleconferences with the analysts, is to sort of take their attention away from their underperformance on the financial metrics. Let me quickly give you another paper that I've been involved with, and that basically looks at green bond announcements. So now, just last year you had more than 900 companies worldwide issuing green bonds. Green bonds are just regular bonds, but the company says that they will use the proceeds from those bonds to invest in environmentally friendly projects. So that's good. So if you think that the company will actually do that, and if you think that the market appreciates these statements about environmentally friendly projects, then the stock market return should be positive when these companies make such announcements. So we went and looked at the market response to the green bond announcement, and we found no such positive response. We found the response was either zero, meaning the market just shrugged it off, or in some cases it was negative. But there was certainly no positive market response. Interestingly, we found that these companies that announce green bond offerings, they do not cut back on their carbon emissions. So you think that you're talking about selling these bonds to invest in environmentally friendlier projects. You think that the carbon emissions of these companies would decline in years 2 and 3 and 4 after the announcement. We don't find any such decrease. In fact, there might even have been a slight increase in the carbon emissions. However, the companies that announce these green bonds, their financial performance in the year of announcement is below below what they should have done in terms of return on assets. Their performance metrics were below average. So again, this is another evidence that when managers are not getting the job done, then they find what it looks like ESG the excuse to show the investors, my financial performance is not good, but here, look at this shiny thing. So that's what may be going on. Now, I also wanted to take just maybe a minute and give you a very quick summary of one of the Morningstar charts that I sent you in the slides. This has to do with, since we're talking about ESG investing by funds, including Mr. Fink's BlackRock. So Morningstar tracks the quarterly inflow of funds into sustainable funds or sustainability focused fund, meaning ESG focused funds. And they do it every quarter. And if you go to Morningstar website, you can download those reports and look at them. Let me give you the highlights of those reports. What the Morningstar report tells you is that this ESG focused investing by funds is mostly a European phenomenon. So most of this investment happens in Europe, number one. Number two, the funds that were flowing into ESG focused funds peaked off in 2021. Since 2021, there has been a rapid decline in funds going into ESG or investor monies going into ESG funds. A very rapid decline after 2021. In fact, in the US, in the last 6 quarters, meaning starting, if you go back to quarter number 1 of 2024, the 4 quarters in 2023, the 2 quarters in 2022, there has been a net exodus of investor funds in the US away from ESG funds. So investors have been taking their monies out of ESG funds and putting those monies into more traditional funds, non-ESG funds. So from the investor, what I'd say the broader aggregate, investors seem to have realized that ESG focused funds is not where they want their monies to be going, and they are moving their monies into non-ESG or more traditional funds. Now, that's what the aggregate data for the US. Even in Europe, the investors are sort of calling back some of the investment, but not as much. So this, when we're talking about funds are focused on ESG, yeah, that's mostly a European phenomena. Even then, it's declining since 2021. And in the US, funds are actually leaving. Monies are leaving ESG funds. So when you say there's a lot of investor interest, I said, yeah, investor interest so that they can take the money out of this fund and go back to their more traditional investments. That's what the data suggests. This is Morningstar data. You can go look it up. I mean, this is not. I'm just describing what's in that data.
And I will make sure to let people know, if you go to our episode page on shapingopinion.com, I'm going to have links to all of the research that Sanjay talks about here, so that you can, if you're interested, you can do your own research, as Sanjay said. We talk about ESG and social is one of the issues, and environmental. These things can get political, and I'm just going to tick off a list here of things that have come to characterize the environment around ESG. Just an example, the Texas Permanent School Fund, that's a $54 billion fund. So they have $54 billion invested on behalf of people in Texas, the Permanent School Fund. I'm assuming that's teachers. It might be retired teachers or both. I'm not sure. So they established just recently an ESG skeptical position, which means they want to pull their money out of ESG funds. And one of the reasons they do it, and this is where that whole political thing comes in, because once you step out of the financial measures and into the social, and like you said, you have a company that it has to decide whether to modernize, maybe automate, and lose employees and all those kinds of things. So your score on ESG for employees is going to be bad because you're laying people off. So that's one example. But this example is, Texas is an oil state, and oil and natural gas. Well, when you have ESG funds that are divesting themselves of oil and gas stocks, and then you have the Texas Permanent School Fund saying, wait a second, you're going to put our people out of work if you do this en masse. So we're taking our money out of the ESG fund because you guys are working against our people.
Mm-hmm.
So that's one. Another one is, and then you have whole states. You have Texas, and then you have Kentucky, government investing, retiree investing. And then you have big firms like BlackRock, Blackstone, and T. Rowe Price that have all blamed what they quotes around this, divergent views. In other words, people have different views of what should constitute an ESG investment and what shouldn't. So you have all of those kinds of things. And then you have this issue, and this is the other part of it. You talk about things that are sort of the darker side of things, because you have companies that are trying to deliver returns, financial returns for investors, and they have this big investor in a BlackRock or a T. Rowe Price or somebody like that coming to them and saying, look, you need to invest more of your reserve money in air cleanup or air pollution cleaning equipment. So you have to take $5 billion and update your emissions to the air or your emissions to the water, because your environmental performance isn't. It's okay. It might be EPA compliant, but it might not be good enough for us when we talk about your carbon footprint and your ESG score. So you have these smaller companies that are saying, look, we can't afford our investors telling us what to do here to comply with an ESG score when we're just trying to make sales and employ people and deliver like that good EPS number that our investors want. So you have people that are starting to kind of resist it at that sort of grassroots level at the same time. So you said two things in your PowerPoint slides that I wanted to ask you about today, because I thought they were very interesting. Those are some of the issues that I ticked off, but now you have other issues like national security and other issues like the government micromanagement of companies, because the SEC exists to govern how companies responsibly report their financial performance and their performance of operations. So if insider trading, that's what you have to think. If someone's insider trading, that's the SEC's sweet spot. They go after the company. Material information, anything that's bad, like Martha Stewart got in trouble for insider trading. So you have companies like that are strictly regulated in how information can go out into the market that affects the stock price. That's the SEC's main job. But now you have people that are saying the SEC can't just limit itself to that. They now have to, mandate what companies are doing, not just how they're reporting it, but what they're actually doing to meet a certain ESG standard on climate, which has nothing to do with finance. And again, it goes back to that apples and oranges comparison. So my question for you there is, should the SEC, I'm not saying the government shouldn't get involved, because they kind of do. They get involved in everything from the EPA to the FDA to the FTC. There's an alphabet regulatory agency for everything a company does. So the question is, does the SEC basically belong in ESG enforcement? That's a lot of letters, but what do you think?
They do not have the congressional mandate to focus on ESG. I'm glad you raised this question about the SEC's focus to get companies to disclose climate-related data. So the SEC mandate comes from 1933 Securities Exchange Act and the 1934 Securities Act. And primarily, they were told by Congress that you should focus on the small investor, provide information to the small investor, the retail investor, make sure that they can make informed decisions. Now, when you go and look at the SEC's this climate disclosure rule proposal that you're referring to, it's a fairly massive rule proposal, more than 500 pages. So you go and look at the first dozen pages or so, and the SEC keeps talking, and as do their SEC leadership. They keep talking publicly and also in that rule, 500-page rule proposal, that investors have shown a lot of interest in climate disclosure. The investors want more information on climate data. Investors want more information on environmental impact. Well, I read that and I was a little puzzled. I said, which investors are they talking about? In the small print, you'll find that they're talking mostly about the large mutual funds or other hedge funds, mostly based in Europe. So the first question is, should the US SEC be concerned about the concerns of European institutional investors? Or even, most of them are Europe-based. Some are based in the US. But again, if you're a large institutional investor, that's not the concern of the SEC. In the entire 500-page document, the word small investor or retail investor barely shows up half a dozen times, and that also in passing. The question that we raised with the SEC formally, I and other finance professors and law school professors raised with the SEC is, have you done a survey of the retail investors in the US? Because that's what your mandate is about. How are these retail investors interested in knowing more about the climate impact of the stocks they invest in? And they haven't responded. But we said, okay, here are some 3 surveys that have been done by various nonprofit organizations. The first one, NORC, based at University of Chicago, they looked at 1,000 plus retail investors. The second one by another nonprofit, the mind escapes me. I think it's not. Anyway, it's in my slides there. They also looked at retail, almost 1,000 retail investors. In both of these studies, the investors were asked, what kind of things are you looking for? 1, 2, 3, 4, 5. The primary concern they have is returns and risk-adjusted returns. The issues on climate and the environmental barely make it to number 5 or number 6 in the things they're interested about. Now, more recently, there's been a survey coming out of Stanford University they did that in 2022 and found that investors that were aged 51 plus, they didn't want to even spend $1 to have the funds they were investing in be more sensitive about environmental concerns. So if you ask individual investors 51 years and older, not even $1. If you ask investors between the age of 19 and 35, and the savings were less than $50,000, how much of how many dollars are you willing to spend on better environmental record of your funds? They said zero. Only investors in the 19 to 35 age group that had more than $250,000 of savings, they were willing to spend some of their money for better environmental record of the funds. But then you have to ask yourself, how many investors have more than $250,000? They are a small microscopic minority compared to the large set of investors out there. This study was done in 2022 that I just described. Since then, last year, Stanford has again updated this study, and they found that the results are even stronger, meaning investors are even now, they were less concerned in 2022. They're even less concerned about the environmental data in 2023. And the SEC has chosen to just ignore ignore this data. If your mandate is individual investors, why are you talking about large institutional investors? I'll tell you why they're talking about large institutional investors. This is a good way for policymakers to implement their political ideas with somebody else's money. And the reality is that, look, now the Fifth Circuit Court and the Eighth Circuit Court has put a stay on the SEC rule. So they, until this thing goes to trial and the outcome of the trial, we don't know whether these rules can even be enforced in the country. But the Supreme Court last year spoke on a similar, on a much smaller case, EPA versus West Virginia, which also had to do with environmental issues. And the SEC rule is 10 times bigger than this EPA versus West Virginia. In that case, which was decided last June by the US Supreme Court, they said that there is this big questions doctrine, meaning if the issues are so big and they impact so much of the economy and so much of the country, then no agency has the legal right to make that decision. That decision can be made by only one body in the US government, and that's called the Congress. You go to the Congress, get the House to approve that rule, get the Senate to sign off on it, and get the president to sign on that bill. Now you can then go enforce what you want. So my sense is the SEC knows that they could not get the rules they wanted through the constitutional mechanism by going through the House of Representatives, the US Senate, getting the president to sign it. So this is the end run around Congress. You're talking about it's become politicized. Who's doing the politicizing? It's not the people that are focusing on shareholder returns, it's the people that want to talk about climate and environment on somebody else's money. They're taking the. So to me, that's a very important issue, is that, the people that are investing in these employee retirement funds, of various states, teachers and other state employees, and also for many of our pension, mutual funds, the vast majority of people there, who are investing in these mutual funds are your average blue collar workers. And, so you want to take their money and use their money for your political principles that you could not get passed in Congress, what I'd say the constitutional way. That to me, sounds very, very, it's a very big question mark as to, why you'd want to do this to these blue collar workers who have a very small savings to begin with. Much of that savings is devoted for their retirement nest egg. And why you'd not want to give them the highest possible, return, and why you'd want to sort of, give them a lower than the highest possible return because you want to focus on things besides financial performance of the company. That to me, really is very disappointing about these people that sort of claim that companies should, I mean, look, companies are paying attention. Like I told you, the shareholder viewpoint does not exclude managers. In fact, managers have to pay attention to employee benefits, employee welfare. Even if managers are just concerned about long-term shareholder value, they have to pay attention to customer concerns. They have to be concerned about the environment and so forth. But they do it in a disciplined way of how does it impact shareholder value. When you're talking about the stakeholder paradigm, anything goes. It's whatever the manager decides. If you think seriously about the stakeholder paradigm that the manager should focus on employees, customers, environment, communities, and then shareholders, other than outright fraud, there is no sort of limiting behavior to what managers can or cannot do. I mean, then the manager can do anything they wanted and say, look, this has got to do with my interest in promoting, this charity or that charity, and I'm, whatever, something else. The manager's primary task is to generate shareholder value, but do that in a way that, they don't spoil their reputation. They have to treat their employees well. They got to treat their customers well. So if you're talking long-term shareholder value, they anyways have to do those things. But if they are doing it exclusively that, and without the discipline of shareholder value, then you get to see things like green bonds and then the managers in your teleconferences talking about ESG when their performance has been poor.
That's so much. I probably had 25 things I didn't ask you that I could have asked you about today, but we're running out of time. So I just wanted to it's great because, and to reinforce what you just said, because one of the things on your slide that was one of your concluding remarks is you said that ESG investing, and this is your opinion, is hurting U.S. investors with an overemphasis on ESG. It hurts blue-collar workers, the economy, and you mentioned national security because, part of ESG investing is, let's say we want electric cars. Well, where does the raw material from electric cars come from? And I'll use an example, China. And China is not necessarily a friendly ally of the United States. So do we want to depend on them to achieve these other ESG goals? So I appreciate your taking the time, Sanjay, to be with us today. And officially, I'd just like to thank you for being with us at the Shaping Opinion podcast.
Nice meeting you, Tim. Thank you for your interest in this work.
To learn more about all that we talked about here, please see our episode page at shapingopinion.com. Make sure to leave a rating and review and subscribe wherever you get your podcast. Want to connect? Check out our website, shapingopinion.com. Follow us on the X platform, Facebook or Instagram at Shaping Opinion. And make sure to join our Facebook group called Shaping Opinion Podcast Listeners. Shaping Opinion is a production of O'Brien Communications. Copyright O'Brien Communications 2024.